Thanks for having me here today, Mark. I really want to get to know the nuts and bolts of this case because it's an interesting case because it's not one you typically get every day. So before we start, I was wondering, first of all, how did we even get here? It's my understanding that the Constitution requires standing to even sue a party.
Standing is an important issue because it determines who is allowed to go into court. So the general rule in America is that a shareholder cannot sue for something that a corporation did. In this case, a limited liability company that owned by the Hages took out a couple of loans brokered by Target Mortgage. It isn't that LLC that sued. Rather, and it's not even the owner of the LLC that sued, it's a beneficiary of the owner, of the borrower, who is allowed to sue. This dramatically expands the range of people who are allowed to sue. And it raises an interesting question. Can the LLC itself now sue again for damages it may have suffered? Because after all, its rights were not adjudicated in this lawsuit.
Okay, so you're telling me the court granted standing to sue the loan broker for damages suffered by the borrower?
Judge Joel Wohlfeil, Wolfeil, a San Diego Superior Court judge, has now ruled not only that a non-borrower can sue a loan broker on the theory that the loan should never have been made, but also awarded an astronomical amount of damages that, if it's upheld, will spell doom for the industry.
Okay, but first though, if there was standing, there has to be a duty owed to the party. Can you tell me what duty the borrower owed?
The first plaintiff is John Schofield Hage. He's a 38-year bank executive in San Diego. Throughout most of his career, he was involved in commercial lending. And his wife, Bonnie Hage, a longtime socialite in San Diego. They had their commercial entities take out cash out loans for what the judge described as a very bizarre purpose, and then sued the loan brokers, claiming that the loan should never have been made to them.
What exactly is a commercial loan broker's job?
A commercial loan broker is a lot like an insurance broker. The value that the loan broker adds to the whole transaction is in finding the best deal for the potential borrower. So the loan broker contacts all their contacts when they have a borrower who says, I want X amount of money on these types of properties, and here's what my income is. The job of the loan broker is to take that information, the request of the borrower, and to contact all the lenders and find out if anybody will make the loan, and if so, on what terms. They communicate that then to the borrower. The borrower decides whether or not that fits into their strategy. You as the borrower decide how important it is for you to have that money in your pocket. If you have a good investment you want to make and you're going to make more than the interest rate, it makes sense to take the loan. But even if you mistakenly take the loan and you have the money in your pocket and you just don't want to pay any interest on it, all you have to do is pay back the bank. Give back the money and the interest stops.
Once the duty was established, how do they calculate the damages?
So what the Hages did is they had previously borrowed about $600,000, secured by 3 of their commercial properties, all rental properties. They sought to refinance those loans and take additional cash out. Ultimately, they took loans of $1.2 million brokered by Target Mortgage. They lowered the interest rate on the pre-existing $600,000 in loans, and they got $700,000 cash out at market rates at a reasonable cost on terms that were fully disclosed to the borrower. What could go wrong? According to Judge Wohlfeil, because the Hages insisted on doing business with a convicted felon and a con artist whom they paid hundreds of thousands of dollars, fully consented to him being their financial advisor, who was employed by someone other than Target Mortgage, the loan broker, the judge said that Target should have discovered that this was a felon Now, they could have discovered it had the Hages told them, because the Hages knew for 6 months prior to the loans that they were dealing with a convicted felon and a con artist. But they intentionally hid the fact from Target that they were giving money to this guy and that he was in fact a convicted felon and he was unlicensed. But nevertheless, Target should have found this out. Stop the loans to the LLC and to the trust so that the Hages couldn't give the money away. Because Target didn't do that, the judge said they couldn't have known about the money, so Target's not responsible for the money the Hages gave away. Instead, Target is responsible for 100% of the interest on the $1.2 million in loans for 30 years, even though $600,000 of that money was used to refinance loans down from 10.5% and 10% loans down to an 8% loan, saving the borrowers hundreds of thousands of dollars over the 30 years. And that is why we're here talking about this case today.
So, in a way of recapping, there was a cash out in 2014. Tell me where that money went, because that's where they calculated those damages off of.
Where the loan proceeds went is very interesting. The LLC borrowed against 2 properties it owned and got about $200,000 in its bank account. That money was not traced out of their bank accounts to anywhere else. The money that the Hages gave away came from their personal account, so there was no attempt whatsoever to trace the borrowed money to the convicted con artist to whom the Hages gave so much away. And so you wonder how these loans are even relevant to the Hages choosing to give away so much of their money. Almost $500,000 was taken out from the Elliott property, owned by the trust, owned by the Hages. Half of that money went to the co-owner, who was not a borrower for some reason, but a irrevocable trust got half the money, $247,000. $247,000 stayed with the borrower of the trust. Again, none of the money was traced to the Hages' personal account and then to the con artist. The Hages claim that these loans are bad loans because it increased their cash flow by $6,000 a month. But they got $705,000 cash out total between these entities. That's enough to make the payments for 12 years. Not only that, they gave away $250,000 to a non-borrowing trust that they could have used. Do the math. $6,000 goes into 24 about 40 times. So that would have lasted about 5 years if they hadn't given that money away. And then they gave $600,000. Again, we don't know where that money came from. They had borrowed money previously from other sources. But they gave $600,000 away to this con artist. That's enough to make about 100 loan payments, obviously. And yet, the judge ruled that Target should never have allowed these commercial entities to get these loans because an additional $6,000 a month was just too much of a strain on their cash flow.
Now, property one, let's call it Kansas Street property. There was how many loans on that?
They took out a 3-year balloon payment loan at 10% interest rate for $375,000 in October of 2013. And then in about February or March of 2014, they got another $100,000. Also a 3-year balloon payment coming due, interest only, at 10.99%. So essentially they had an 11% loan and a 10% loan of totaling $475,000. They went to Target Mortgage and they wanted to refinance that and take $150,000 cash out. So Target was able to find a commercial lender who was willing to make that loan. The borrowers had full knowledge of the rate, terms, and costs, all of which was agreed to be reasonable and at market rates. And so they got an 8% loan, amortized over 30 years, so they got rid of the balloon payment, at 8% interest. Now what the judge said was because the overall loans were too costly to the beneficiary of the owner of the borrower, Target has to pay 100% of the interest on that $475,000. That's 8% interest 8% of 475 for 30 years, even though the borrower saved hundreds of thousands of dollars in interest based on these loans because the loans went down by 2 and 3%.
Now, next property is the Elliott Street property. It's my understanding that there was 2 loans on that, and Target Mortgage got them a lower rate as well.
The Elliott Street property that was owned by their living trust. And it's essentially the same theory. They took all this cash out under the name of the trust, and then they said the trust might not be able to pay that back, and therefore the judge ruled that Target Mortgage was required to pay the interest for 30 years on these loans.
Now, next, it's my understanding there was a Tennyson property, which pretty much the entire case stems from. Can you kind of walk me through the steps of how the court first decided that Target Mortgage owed them a duty, next, what they did to calculate the damages, and finally, how those damages were calculated over the period of time?
The Tennyson property is a loan unto itself. It's a commercial property owned by the LLC, which is owned by the trust, which the Hages are beneficiaries on. It had pre-existing loans. John Hage, he came in and he said, I have a 10% loan, I would like to refinance it. Target said fine. They took the loan application, found a lender who would be willing to refinance it at 8%. When the loan payoff came in, though, Target discovered that Mr. Hage had misstated how much the prior loan was. It was a 5% loan. That wouldn't make sense to get a new loan because the new rate would be 8%. So Target canceled the loan. They told the lender and the borrower the loan is off, it doesn't make any sense. It was John Hage who insisted he had to take $50,000 out of that property who got the loan restarted again. He said he had made a personal loan to his company, and that company had to pay it back to keep the books straight, to save his 1031 tax-free exchange so he could sell the property and not have to pay taxes on it, and to avoid piercing the corporate veil. In other words, it was very important to ensure the integrity of that corporation. Target had a fiduciary duty to pass that information on to the lender, that their borrower that they were representing wanted this type of loan. So Target passed that information on to the lender. The lender said, we'll give you that loan, Mr. Hage. We'll give the loan to the LLC, but we want the managers of that LLC to handwrite in their own handwriting that they understand in return for getting this $50,000 out, they're going to end up increasing their loan from 5% to 8% on the pre-existing loan plus the cash out. Both managers handwrote a letter and signed it stating they understood this, and on that basis the loan was approved. How is it that the Hages can then sue the loan broker and force the loan broker to pay the interest on this loan? It doesn't make any sense. But Judge Joel Woolfield says that because the overall loans increased the net cost by $6,000 between both entities, that the Hages can sue and get 100% of the interest on this loan and the other loans as damages.
And it's my understanding Target Mortgage got them the lowest rate.
They reduced the out-of-pocket cost, the monthly out-of-pocket cost by the borrowers. When you refinance from 10% down to 8% on loans, even though you're paying a little bit more in principal so that you can pay off the loan in 30 years, your payment goes down. So the only reason the payments went up on the loans that were secured by the Kansas and the Elliott property is that the Hages pulled out almost $550,000 out of those properties. The Hages borrowed $1.2 million. So were Target to pay this judgment immediately, the Hages would have enough money to pay off the loan completely. They would get to keep the $700,000 cash out that they got. And they would have another $700,000 in their pocket. So they would have $1.4 million and would have to pay zero interest on any of the loans for 30 years. This makes no sense.
Is there anything that other brokers can do to protect themselves? What can we do as a society to protect ourselves from this?
Now, what you can do about this is severalfold. One, keep abreast of this situation. We are planning on appealing this, and in fact, an appeal is in process now. And so we want to hire the best appellate attorneys that we can. And so we have a legal defense fund that we're setting up, and we would like to see if people will help us to defeat this. But also you can contact your commercial lenders and your commercial loan brokers and let them know about this. Something smells fishy about this case, and generally the best disinfectant is light. So the more light we can shed on this, the more people know about this, the more outraged people will get. And I think that we can prevent this type of thing from getting any traction, because if it does, not only are the damages going to be outrageous, but the number of people who can sue commercial lenders or commercial loan brokers is going to skyrocket. And that's going to drive up the cost of loans. It's going to dry up the business of commercial lending, which is so vital to the United States economy.